and welcome back to Intelligent Investment Today. In this episode, we complete our trilogy of financial statement analysis through the lens of Benjamin Graham. Over the past two podcast editions, we've already explored the balance sheet. We've examined the profit and loss account or income statement. And today we turn to what many experienced investors consider the most revealing financial statement of all: the cash flow statement. Because while profits can sometimes be manipulated and asset values can occasionally be overstated, cash is much harder to fake. A company either generates cash or it doesn't. And for intelligent investors, understanding how cash moves through a business can reveal an enormous amount about the financial quality, operational strength, and long-term sustainability. Today we're going to explore what the cash flow statement actually shows, why it matters so much, and how a Graham-style investor would use it to separate strong businesses from weak ones. So sit back, tune in, and get ready to take on board yet another lesson in value investing as inspired by Benjamin Graham. So what exactly is the cash flow statement? The cash flow statement tracks the actual movement of cash into and out of a business over a period of time. Now this may seem sort of similar to the income statement, but the two are very different. The income statement is based largely on accounting principles. Revenue may be recognised before cash is received. Expenses may be recorded before cash is paid. Depreciation reduces reported profits, even though no cash physically leaves the business at that moment. In other words, accounting profits are not the same thing as cash generation. And this distinction is very important. A business can report healthy earnings while struggling financially if cash flow remains weak. Conversely, some businesses may generate strong cash despite relatively modest accounting profits. This is why many experienced investors eventually arrive at the same conclusion. Cash flow often tells the real story. Now, the cash flow statement is generally divided into three sections: operating cash flow, investing cash flow, and financing cash flow. Each section reveals something different about the business, and together they provide a much fuller picture of the financial reality. Let's start with operating cash flow. This is perhaps the most important section for long-term investors. Operating cash flow shows how much cash the company generates from its core business activities: selling products, providing services, running operations. In simple terms, this tells us whether the business itself is producing cash. And for Graham-style investors, this matters enormously, because ultimately, businesses survive on cash generation, not accounting appearances. Now, one of the first things intelligent investors often look for is consistency between earnings and operating cash flow. If a company regularly reports profits, but operating cash flow remains persistently weak, that can be a warning sign. Why exactly? Because it may suggest that profits are being supported by aggressive accounting assumptions rather than genuine economic performance. For example, a company may recognise revenue before cash is collected, or it may capitalise expenses to inflate reported earnings. Now, this does not automatically mean fraud or manipulation, but it does warrant closer examination. Graham was naturally sceptical by temperament. He thought that investors should approach financial statements critically rather than blindly trusting the headline numbers. And the cash flow statement often helps reveal whether reported profits are truly translating into economic reality. Another key concept is free cash flow. This is generally defined as operating cash flow minus capital expenditures. In other words, how much cash remains after the company has spent what is necessary to maintain and grow the business. This is incredibly important because some businesses require enormous ongoing investment simply to stand still. Heavy manufacturing, airlines, shipping, energy infrastructure. Large amounts of cash may flow into the business, but huge amounts may flow straight back out through maintenance spending. Other businesses, however, are far more cash generative. They require relatively modest ongoing investment while producing substantial excess cash. And these types of businesses are often highly attractive from a value investing perspective. These businesses can pay dividends, repurchase shares, reduce debt, acquire competitors, or reinvest for growth. Strong free cash flow gives management flexibility and resilience. This brings us to another important Graham-style principle: the difference between accounting profits and economic value. A business may report rising earnings while constantly consuming cash, and eventually this can become dangerous. Because businesses cannot pay creditors, employees or suppliers with accounting profits alone. They need liquidity. They need cash. This is why cash flow analysis becomes particularly important during periods of economic stress. Weak businesses often reveal themselves through deteriorating cash generation long before collapse becomes obvious. And Graham understood this perfectly. His entire philosophy revolved around protecting investors from permanent capital loss, and strong cash flow provided evidence of operational resilience. Weak cash flow often signals hidden fragility. Now let's move on to investing cash flow. This section tracks cash spent on or generated from investments, capital expenditures, acquisitions, asset sales, and investments in other businesses. Now, negative investing cash flow is not necessarily bad. In fact, healthy, growing businesses often invest heavily. The key question, then, is whether those investments generate attractive long-term returns. This is where analysis becomes more nuanced and less definite. A company constantly spending on expansion may create enormous future value, or it may simply be destroying capital inefficiently. The cash flow statement helps investors observe this behaviour over time. Is management allocating capital intelligently, or merely pursuing growth for its own sake? Again, Graham cared deeply about rational capital allocation, because ultimately, management's job is not simply to grow the company. It is to create shareholder value. Now we arrive at financing cash flow. This section shows how the business raises or returns capital through issuing debt, repaying loans, issuing shares, paying dividends, repurchasing stock. And this section can reveal a great deal about the company's financial health. For example, if a business consistently generates weak operating cash flow, but repeatedly raises debt or issues new shares to survive, that may indicate underlying weakness. On the other hand, a company generating abundant cash, while steadily reducing debt or returning capital to shareholders may reflect significant financial strength. Again, context matters enormously. Numbers alone are never enough. Investors must interpret what those numbers actually mean about the economics of the business. One of the reasons the cash flow statement is so valuable is because cash tends to expose reality over time. Narratives can persist for years. Market excitement can remain elevated. Accounting adjustments can flatter profits temporarily. But eventually, cash generation becomes unavoidable. A business either produces cash sustainably, or the underlying economics eventually break down. This is why many experienced investors place enormous emphasis on cash flow quality. And although Graham wrote before modern cash flow statements became more standardised in the way they are today, his broader philosophy strongly aligns with this mindset. He constantly sought tangible evidence of financial strength, real earning power, and conservative analysis grounded in reality rather than in optimism. Another important aspect to take into consideration with cash flow analysis is cyclicality. During boom periods, many businesses appear highly cash generative. Businesses such as commodity companies, construction firms, industrial manufacturers, the airlines. Cash pours into the business during strong economic conditions. But intelligent investors must ask whether those cash flows are sustainable across a full economic cycle. Because temporary surges in cash generation can create dangerous illusions. And Graham was always highly aware of cyclical risk. This is why long-term averages and conservative assumptions mattered so much in his analysis. He did not want investors extrapolating unusually favourable conditions indefinitely into the future. Cash flow analysis forces investors to ask grounded questions. Is the business actually generating cash? Can it fund itself internally? Or does it depend constantly on external financing? Because eventually, economics matter. And the cash flow statement often provides one of the clearest windows into those economics. From a value investing perspective, one of the most attractive characteristics a business can possess is durable and growing cash flow, combined with financial conservatism. These businesses often have strong competitive positions, pricing power, operational discipline, and resilience during downturns. Importantly, they also tend to possess flexibility. And flexibility is enormously valuable during uncertain times. A cash-rich company can survive crises, seize opportunities, and compound value over long periods. This is one reason why investors such as Warren Buffett place such extraordinary emphasis on cash-generating businesses. Because over time, strong cash flow supports long-term shareholder returns far more reliably than exciting narratives alone. As we come towards the end of today's edition, it's worth reflecting on how the three major financial statements work together. The balance sheet shows the financial position. The income statement shows accounting profitability. And the cash flow statement reveals the actual movement of cash through the business. Together, they provide a far more complete understanding than any one statement alone. And intelligent investing requires examining all three. Because businesses are ultimately financial systems. Assets, liabilities, revenues, expenses, cash generation, capital allocation, all interacting together. And Benjamin Graham understood this deeply. He thought that investing should be grounded in careful financial analysis rather than speculation, excitement, or prediction. And the cash flow statement remains one of the most powerful tools investors have for understanding the underlying economic reality of a business. That brings us to the end of today's episode. A look at cash flow analysis through a Graham-style lens. And a reminder that while stories may drive markets temporarily, cash generation ultimately reveals the true quality of a business. If you've enjoyed, do subscribe or add to playlist so you need never miss a future edition. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.